Hello students, let us start our next session for the economic survey, and this session will be regarding the financial system of India. As I have done it in the previous sessions, I will discuss some of the key indicators and I will analyze them. So major trends we will try to follow through. So again, if we have to analyze the financial system, we have to look at it from the breakup of the financial system. And the best breakup to study Indian market is to study the institutions, the regulatory institutions where we study the RBI, SEBI, the monetary policy. So important parameters to look at these are money supply, liquidity, policy rates. Okay, these are regarding RBI. And regarding SEBI, these are bond yield, NBFC, capital market. Okay, what is the participation there? What is the resource mobilization, and what are the other numbers? And then we have the banking system, and we will look at the credit rates, lending rates, and the stability and the health concerns regarding our banking sector. So the survey that we are discussing is mostly a data series because survey is giving you the data for the whole last year. And the objective here is to build a narrative around this data and to simplify the data so that you can remember it. You cannot remember or mug up the tables. It is almost impossible. And that should not be the objective either. You should remember certain data in certain context. Even all these data you need not remember. But if you remember some of the trends and you can talk about whether it is falling or decreasing, etc. in your answers, then that would be good. And the best way to remember data and understand data is to understand why there is a certain trend and why that trend is changing. And that is exactly what we have been trying to explain. So let us look at these parameters one by one. We will first start with the monetary policy aspects. The first parameter we look at is the money supply in the economy and the liquidity conditions. So if you look at the money supply, then you can see that this is our currency in circulation, that roughly how much money supply is there. Okay, and in this currency circulation you can see a big drop in 2016-17. This drop was because of demonetization. In 2016 November, we brought demonetization and money supply in India significantly reduced as a result. The next year we see a big jump after that, and that was again because of demonetization, because money supply will never be reduced. It will catch up on its own. So next year, the money supply recovered from this level, the lower levels, and also increased what it should have been. So money supply followed its trend. For example, money supply was following this kind of a trend. Then money supply followed the trend. Just because of demonetization, we went like this and then recovered like this. Okay, and exactly back to the same trajectory. So because of this, see, a growth from here to here would be around, let us say 15%. But because we had a decline, this growth here is this 37%. And that is what we see here. And this is something we also call V-shaped recovery. Okay. So we see some decline in the money supply and then increase again. And since then we see a steady money supply increase. And the 2021-22, since it is a partial number, it is a half yearly number, we see roughly the half increase here. Okay. So this number is roughly half of what was there in the previous years. So what I'm trying to say here, that the money supply remains unaffected by any kind of crisis and the policy changes here. Okay, and this is a good witness to this. 15% it is rising, and from where this 15% number is coming? This 15% is the increase in our nominal GDP. Roughly between 12% to 16%, 17% is our increase in the nominal GDP. In 2021-22, the year that is going on, we expect increase of 17% in our nominal GDP, because this year we expect much higher growth. Again, it is a V-shaped recovery, so we will not only cover up the loss of the previous year, but we will also try to get back to our original trend where we were. So that is why this year the increase in nominal growth is more. Whenever we say India is growing at 6% growth, 7% growth, that is always the real GDP increase. And nominal GDP increase is much higher. We adjust for the inflation and then we get the real GDP increase. When we measure the real GDP increase, we look at how much production has increased in the country in the production quantity terms. Whereas in the nominal GDP, we look at how much is the value of production last year compared to this year, or compare what is the value of production this year compared to last year. So in value, we see much higher jump because not only production is increasing, but also prices are increasing. That is why nominal GDP rises much faster. And the change here usually represents that increase. Okay. So this is what explains to you the currency circulation numbers here. Now, here we see something interesting. Currency circulation was not affected much because there was adjustment between the cash in banks and the cash with public. 2020-21, the previous year, we see much greater decline in the bank currency or currency with the bank, because people were withdrawing their savings. You all remember this because of the COVID crisis now. So because of COVID crisis, because of lockdown, many people were not receiving their salaries, and because of that they had to withdraw their savings, and that is why the currency with the banks did not increase as it would have. Okay, so that is what partially explains this increase in the currency with public. And when you see this year again, when people are earning money once more, they are putting money back into their bank accounts. Okay, so this is what explains some of the datas here. And rest of the numbers we need not concern too much with. Okay, so not all the numbers here are very useful for us. For example, bankers' deposits with the RBI, that is largely because of the CRR. We see a decline here because we decreased our CRR from 4% to 3%. And that is why there was a big decline in the bank's deposit with the RBI. Next year we see increase because we increased it from 3 to 3.5%. This year we again see a big increase because we further increased from 3.5 to 4%. So this is what has happened here. And similarly, demand deposit, time deposits, okay, the NDTL, bank's liabilities, they are also increasing at a steady pace. So what is interesting takeaway from here is that money supply overall does not get affected too much by the external factors. It roughly grows because it grows roughly at the rate of your nominal GDP. And even if for some reason there is adjustment, there is always a very quick recovery. So we have seen the impact of demonetization, and we also see that because of COVID also there is no impact here. The impact is within the constituents. Adjustment currency with public increased, in the banks it decreased. Let us move to the next number, that is the liquidity condition. Before we move ahead, let us understand what is this liquidity condition. So you can see some text here. I will read it out for you. The liquidity conditions reflect the availability of credit in the system. So here we see how much credit is available. Okay, how much is savings in excess of investment, how much supply is there in comparison to the demand. Okay, so when this number is negative, as we see here, that means the supply is more than the demand. Okay, negative sign indicates surplus liquidity. This text is taken from the survey itself, and surplus liquidity in the banking system is indicated by the total net LAF absorption, liquidity adjustment facility, repo and reverse repo. So it basically reflects that money supply is abundant, money supply is significantly available, and that was because of the certain decisions we took in order to increase the money supply. And because of higher liquidity, the interest rates also have been low. And in the next page, we will look at the interest rates now. Let's look at the interest rates and the policy rates. So here we see these are these are certain policy rates here. We see it from 2011 to 2021, and you can see the numbers here in 2020-21. They are lowest in the last decade, and they are lowest not only in last decade, they are lowest historically. We have arrived at a level where our interest rates are historically low. Okay, and you can see here these are the policy rates, the repo, reverse repo, bank rate, or the marginal standing facility, which is at present running equal to the bank rate in India. So it is not necessarily always the same. Okay, and these are very different numbers from each other. These can vary also from each other. There is no necessary condition that these are always equal, but since they are equal in the last 2-3 years, we have maintained a single column for them. So you can see here that repo rate has been as low as the 4%. Okay, and the bank rate is also very, very low, around 4.25%. And there was also a time not so long ago when interest rates, the policy rates were almost 7%, 7.5%. So we have come a long way from there. We have come to a situation where interest rates have significantly decreased and almost halved in the last 6-7 years. And why interest rates have decreased? We have decreased the interest rates so that we can encourage people into investing more. We can encourage people to come out and take more loans, so that some of the negative impact of the lockdown, some of the negative impact of the COVID crisis we can reverse, we can avoid. So that is our point here. Clear? So the policy rates have declined. You just need to remember this much. You do not have to remember the numbers. And if for reference you want to remember this, that your repo is 4. Okay, and it automatically would mean that the reverse repo is less than repo and bank rate is more than repo. Repo is middle, not necessarily middle, but it is in between the bank rate and the reverse repo rate. And you know the difference between the reverse repo rate and your MSF rate, that is also called the policy corridor. So this is our policy corridor. Red line reflects repo, the yellow line reflects the MSF or the bank rate, okay, and this gray line here, this reflects the reverse repo rate. The gap here, okay, this gap here reflects our policy corridor. What is the importance of policy corridor, first of all? Policy corridor is the area of maneuveration for the RBI. And if I have to read a line out of the RBI bulletin, it would be, the corridor structure for the policy rate is a helping guide for RBI to design its monetary policy operations. Okay, so it acts as a helping guide for RBI to set its monetary policy operations. And one more thing that we have here in this figure is the WACR, which is weighted average call rate. Okay, so this is the call rate. Call rate is the interest rate which is charged on the overnight money, which is charged on the emergency loans, which are required immediately and only for one night. Someone has to deal with some emergency, usually it is the financial institutions, and if they need loan only for one night. Okay, for example, ICICI has to pay 100 crore rupees to HDFC because of the checks that were drawn on their behalf. Okay, so Now this 100 crore rupees, for example, they can't arrange the cash the same day for some reason. Then what they will do? There is no option that they will not pay to HDFC. That option is not there. That option is not there because if banks are going to default on their payments, the system will collapse. So banks have to pay. Always they have to pay. So in order to adjust or in order to cover up that, banks take a loan for one night to arrange for short-term cash mismanagement. And this is what creates the call money market, because they need loan for only one night and emergency loans they require. Now RBI bulletins say that the ideal situation is when this policy corridor is bit wide, okay, and this call money rate is somewhere in between of, it is somewhere in between of the policy corridor, and it is not at present. So this is a very different kind of a trend from our objective. It is quite technical actually. Usually for general studies we do not deal with such technical issues, but very briefly I'm telling you for this, that if call money rate is bit lower than your or is below your policy corridor, or call money rate falls below the reverse repo, what does it mean? It means system has abundant cash, system is cash surplus. Okay, what does it reflect? Your call money, it is less than reverse repo. If it is so, what does it reflect? System is cash surplus. Banks have more money than they can lend out. And this is precisely what we saw in the previous page. Let me go back there and show you again. See this liquidity condition. This shows there is excess cash. There is more money supply than the demand. Okay, and this is what reflects this low call rate. So this is interesting, and this reflects that at present increasing money supply is not a very useful policy decision. अब जो मैं बताने वाला हूँ आपको वो बहुत इंपॉर्टेंट है, वो सुन लीजिए. ये मैंने टेक्निकल पॉइंट इसीलिए डिस्कस किया बिकॉज इसके बाद जो पॉइंट है वो हमारे लिए बहुत रेलेवेंट है, एंड वहाँ पे हम ये एक्सप्लेनेशन यूज कर सकते हैं. आई एम बीइंग bilingual at certain points because there is a lot of requests from students that I should explain one or two lines somewhere in between in Hindi. This helps them to understand. So nothing to worry for anyone else. Those who can't understand Hindi, there is obviously no way I'm discussing in Hindi. I'm being bilingual at few places. And since you can't understand what I said, so you do not have to worry. Whatever I said in Hindi, I'm translating it or I'm repeating it in English. So that is not an issue for you. So the policy corridor, I've explained that this call money rate should be above reverse repo. Okay. अगर ये कॉल मनी रेट इसके बीच में नहीं है तो इसका मतलब है सिस्टम में कैश का सरप्लस है. एंड व्हेन देयर इज कैश सरप्लस इन द सिस्टम, then we have a problem. Then we have a problem, and this problem is called the excess money supply. In such situation, there is no benefit of decreasing the interest rate further. This point we have to remember. When there is excess liquidity in the system, please write this point if you want to. On this, in fact, question can also come. When there is excess liquidity in system or in financial system, then decreasing interest rates further is not a good idea. Okay, and once you have written it down, let me explain why it is not a good idea. It is not a good idea because you can decrease interest rate further, people are not going to take loan. जिनको लोन लेना होता वो इतने कम इंटरेस्ट पे लोन ऑलरेडी ले चुके होते. लोगों को लोन नहीं लेना है. People do not want to take loan at present, and this is the reason why the decreasing of policy rates is not going to help. And I've already discussed in one of my previous session on economic survey, and you can check it out. That was the state of the economy. That demand is one of the most important parameter which affects the investment and not the interest rate. Why I will open a new factory? मैं एक नई फैक्ट्री क्यों लगाऊंगा? मैं नई फैक्ट्री इसलिए नहीं लगाऊंगा कि बाजार में लोन कम रेट पे मिल रहा है. मैं बाजार मुझे कोई पैसा दे रहा है इसलिए मैं नई फैक्ट्री नहीं लगाऊंगा. मैं नई फैक्ट्री तब लगाऊंगा जब मेरे प्रोडक्ट की डिमांड बढ़ रही है और मुझे लगता है मेरी करंट फैक्ट्री से काम नहीं चल पाएगा. When I feel the current factory is inadequate to meet the supply in future, then only I will open a new factory. And once I have made a decision to open factory, then I will look at the financial market. Okay, is interest rate low enough for me to invest? Is it a good time to invest or not? So someone who is already looking forward to open a factory, perhaps he would be influenced or she would be influenced, not otherwise. सिर्फ इंटरेस्ट रेट लो है इसलिए लोग फैक्ट्रीज या इन्वेस्टमेंट नहीं करते हैं या फैक्ट्री नहीं लगाते हैं. सो दैट वाज द पॉइंट आई वांटेड टू एक्सप्लेन हियर इन अ वेरी सिंपल वे. सो लेट अस मूव अहेड नाउ. Okay, so whatever I have discussed here is that our interest rates are already very low, and throughout the crisis, roughly from the mid of 2020 to now, we have not changed our policy rates, and this is because it would not have helped us. That was the point I wanted to explain. Okay, and why we have done it? Because our call money rate was going below the reverse repo, and it is an indicator for RBI or central bank that it is not a good time to cut interest rate further. In economics, this is also called a situation similar to liquidity trap. There is already excess liquidity. Further increasing is not going to help. Okay, so that is there. Let us move to the next page. In the next page, we will see the banks now. Bank credit and lending in India. Let us analyze these charts. Okay, from here onwards, the time required to explain or discuss will not be too much because we have already discussed the policy making or the monetary policy part here. So, as policy rates have gone down, we see the weighted average lending rates have also gone down. Okay, so the policy rates we have seen the reverse repo. Okay, so just a minute, sorry. We saw how reverse repo fell and then flat line. Okay, that is how reverse repo were behaving, and you see a roughly similar graph in the bank's lending rate. So banks lending rate have gone down from roughly 10% to roughly 8% today. Okay, roughly 8% today. So this much low interest rates have come down, and this is exactly what we have seen in the policy rates. How much policy rates have fallen? Roughly the same number. So policy rates are a very important factor that changes the lending rates of the banks. If bank can borrow at less rate from RBI, then they can also lend out at a less rate. So this is what we wanted to see here. But there is an interesting thing which we have to discuss here. There is a big gap between this red line and blue line. What is this red and blue line? This blue line is the new loan. अगर मैं आज लोन लूं तो मुझे कितना इंटरेस्ट देना होगा. दिस इज व्हाट वी सी फ्रॉम दिस ब्लू लाइन. Okay, if I'm taking loan today, then I have to pay this much interest. But if I've already taken loan, and since loans are on floating interest rates, there is a big gap here. On the old loans, interest rates have not decreased that much. Okay, so there is a big difference between the interest charged from the people already in loan with the banks compared to the new loans. So if you are a new customer, you can get much better deal compared to what you already would have been paying as an existing customer. For example, I am paying a home loan. My home loan was charged at 9.35%. I recently switched my bank. Okay, I shifted my loan from ICICI to State Bank of India. And shifting it from ICICI to State Bank of India, it decreased my interest rate to 8.5%. And that was the lowest I was getting. Okay, and roughly you can see here, in fact, the best deals on the existing loans, that is around 9% today. So SBI in fact gave even lower interest rate. Whereas if I wanted to take new loan, ICICI was ready to give me new loan at 7.5 interest rate. Okay, that was last year. So you can see here, for the old customer, the interest rate is 9.35%. For a new customer, the interest rate is 7.5. This is unfair. This is unfair actually. This should not be there. And this problem is called the monetary policy transmission issue. Monetary policy transmission failure we see. These lines should be close. We do not expect them to be equal. Loan interest charged from existing customers compared to the loan interest offered to the new customer. There can be a difference, but this line should have been something like this. Okay, not this much of a gap. It can remain higher, it can remain lower. Okay, it need not be same. Same ho bhi nahi sakta. But what we see here is unfair to certain people. Okay, not because I have taken a loan. RBI also recognize this to be unfair. But banks can't help it, and this is because of the monetary policy transmission problem. The problem here is banks have higher cost for the loans taken in the past. ओके, बैंक ने भी वो पैसा कहीं से लोन लिया है, बैंक ने भी पुराने टाइम से में बॉन्ड्स उठाए हैं, बैंक ने भी पुराने टाइम में लोन लिया है, उसी लोन को आगे उन्होंने पब्लिक को दिया, उसी पैसे को. So their cost is higher for the old loan, and that is why we have a monetary policy transmission problem. So I can't really go into the detail of monetary policy transmission as of now. Okay, I cannot really. There is no scope to discuss it in details today. So, but I'm giving you some idea here that there is a monetary policy transmission, and this is how we can identify the problem very easily. The big gap between existing customer and the new customer. One of the reasons, there are several reasons, but one reason I would like to discuss here, that when you open fixed deposit in the bank, you get a fixed interest rate. After that, interest rate may fall, after that interest rate may increase, but you get a fixed interest rate. Okay. As a customer, you have a choice. You can terminate your FD in between. If interest rates have increased significantly, break your FD, open new FD. You have a choice. But bank does not have a choice to terminate your FD in between. Bank nahi kar sakta. If interest rate have fallen too much, then bank will be under pressure. So bank ने जो पुराने टाइम में deposits लिए हैं, वो higher interest rates पे लिए हैं. And that is why on the old loans, they want to charge higher interest rate. This is one of the biggest reason behind this. And the common question from the students would be that, sir, why don't we make our fixed deposits flexible? Like lending is flexible rate, why don't fixed deposits are flexible rate? So there are various reasons for that. Bank can't do that because they won't get money after that. There are so many government certificates, so many government bonds, and other PPF etc., which give you fixed interest rate. So banks have to compete against them. Okay, so there is a big depth in this topic. There are so many different reasons behind it, the monetary policy transmission. I can't go further into details, so I'm finishing the monetary policy transmission here. This is an interesting way how do you pick up there is monetary policy transmission problem. Okay, so this gap reflects us that there is MPT problem. Monetary policy transmission is called MPT. Now, this reflects the bank's credit growth. Okay, so bank's credit growth roughly around 16% somewhere in 2018 end, and then in 2019 only bank's credit growth was declining. 2019, mind you, was a bad year for us. Indian economy was facing slowdown even before the COVID crisis. Okay, and COVID crisis further created a problem. Okay, so we were already in problem. We were somewhere here. Then rather than recovering, we were expecting to recover from here, but instead we went further down. And now only we are recovering. Okay, so from the last quarter here, we see that we are recovering a bit. So our credit growth remained very low, and as a result, our growth also remained low throughout this period. So bank's credit growth is a direct reflector or is directly proportional to your income growth or the GDP growth. And that is what we see here. Then here we see the credit growth sectoral wise. So in sectors we can see agriculture, which was unaffected by the economic slowdown and the COVID crisis. The green is the agriculture line. You can see the green line is constantly stable, okay, and in fact rising overall a bit. And on the services sector, we see a big decline overall. See the credit growth in the services sector here. So services had the biggest decline and agriculture had a stable growth. That is something I've already discussed in the state of the economy earlier. If you have not seen that video, please check our channel, check the other videos and you will find. Okay. So it was discussed few days ago and it is already there on our website. So these are the two interesting patterns we see here. A big decline in the credit for services sector and a steady and stable increase in the agriculture sector. And as a result, the size of services in Indian GDP has fallen. And the size of agriculture and industry has increased as a result. So this is an interesting trend for us. Let us move ahead. Now, parameters which reflect the bank's health, the NPA and the CAR. So, gross NPA ratio and the net NPA ratio. So here we see that the NPAs, they've risen sharply from 2014 onwards, and from 2014 onwards specifically because then RBI changed its policy very aggressively. 2013 was the time, towards the end of 2013, mid of 2013, Raghuram Rajan was chosen as the RBI governor. And for the next 5 years, he remained, 3 years, he remained the RBI governor. And Raghuram Rajan brought a lot of reforms. He wanted to change the way the bank give loan, and he wanted bank to have their proper accountability, reflect their true numbers. As a result, we changed the calculation methodology of NPAs. We forced banks that they do not renew their loans to the people who are finding it difficult to repay. That you do not evergreen the loan. उन लोगों को लोन बार बार मत दीजिए जो डिफॉल्ट कर रहे हैं. And as a result, so many people who were taking new loans to pay old loans, they were not able to repay their loans. As a result, NPA increased. And similarly, the calculation methodology change also increased our NPAs. Banks became more strict and we see a big rise in NPA. Now, Raghuram Rajan himself said somewhere around 2018 that these are not new NPAs. During my tenure, NPA did not increase. These NPAs were already in the system. They were hidden behind the techniques of the banks to reflect NPA to be less than what they are. And what I forced them is to come clean. तो रघुराम राजन ने कहा कि मैंने बैंक्स की ट्रांसपेरेंसी को इम्प्रूव किया है. ये NPA ऑलरेडी सिस्टम में थे. These NPAs were already in the system. I have improved the transparency. And now you can see these NPAs. And now at least when problem is visible, we can solve it. And he was right here. And these NPAs are largely from 2006 to 2012 period or 2007 to 2012 period. So after this, we see a big rise in NPA. Okay. And only after a certain period we could control this almost a pandemic in itself, and now for quite some time the NPAs are falling. Okay, so it is a good thing that a very worrying trend is now finally getting controlled. Clear? And it is our capital adequacy ratio, and you can see our capital adequacy ratio has improved over time continuously, and this is a good thing. That means the banks have enough capital to manage their balance sheets. Where do capital adequacy ratio helps? Capital adequacy ratio helps you in several ways. And capital adequacy ratio particularly is the money which belongs to the bank itself. There is some money which we deposit into the bank, that is bank's liability. Then there is some money which bank give loan, that is bank's asset. What is this capital? This capital is bank's money. बैंक भी तो एक institution है, उसका अपना पैसा भी होता है. That is bank's capital. And bank's own money, if it increases, that means bank has a monetary base to deal with the losses. Bank has resource base, and that is what we see here. If the CAR rises, this is a good sign for the banking system. And we can see two good trends here, that bank's health is finally in a certain way now improving. We have to wait for 2-3 more years to see whether this trend is more sustainable or not. But at present, we can say that the bank's health is now improving. Now let us look at the NBFC, the contribution of non-bank finance corporations. I will not discuss too much, just some data I will share with you, or some trends rather I will share with you. So, the NBFC credit, this is the NBFC credit, okay, the growth rate. From 2014 to 2018, we see a very big growth in the bank's NBFC's credit. Just a minute. Yes. Okay. We see a big growth, and then after we see a complete crash. What was this? Serious students definitely would have read about or would have heard of the ILFS crisis. Okay, ILFS and the NBFC crisis that India had in 2018. And it is because of this crisis around 2018 that there was sudden crash in the NBFC credit creation. Our NBFC sector had a problem at that time, and its growth suffered. Okay, so it now was growing at a much lower rate after this, and still its growth rate remains low. So its growth rate, which should have been around 15-20%, as I've told you, these indicators work roughly at the same rate as our nominal GDP. Our nominal GDP was increasing around 11-12%, 13%, and the credit growth in NBFC was around 15-20%. So roughly it follows the same trajectory. But here we see a sudden jump. This was a bubble that was being created. I hope you understand what is a bubble, financial bubble. So the NBFC credit started to expand very suddenly. Its credit growth started to increase suddenly. And this was because certain institutions flouted some norms. Certain institutions, they were doing certain wrong practices in order to increase their credit growth. As soon as we discovered the problem, we took certain steps, and immediately we see there is big crash here. And this is something we wanted to understand here. So NBFC sector has seen some ups and downs, and now it is back to where is close to the nominal GDP growth. Most of the parameters in economy follows your nominal GDP growth, remember, not the real GDP. It is the nominal GDP growth. What is the value of your production? If value of your production is going to increase, everything will increase roughly in the same proportion. So our nominal GDP increase is close to 12-15%, and credit growth, money supply growth, all of these follow that. So that is an interesting point for you to remember. And this is the sectoral distribution of NBFCs. Okay, and we see that NBFC plays a big role for industry. Okay, roughly 40% of NBFC credit has gone to industry. Okay, and then another 30% goes to retail, people who want to purchase something. For example, you purchase a washing machine on EMI. For example, you purchase some other motorcycle on EMI. Now there are many private institutions which give loan. Bajaj Finserv, for example, Muthoot Capital. There are so many private agencies which give loan now. And when you go to different agencies to purchase products, they have a tie-up with these NBFCs. So we see a lot of personal loan created by the NBFCs. Okay. And then there is some loan for the services and non-food credit and the agriculture. So NBFCs particularly play a big role in the retail and for the industry. So this is where its importance lies largely. And NBFC credit to GDP ratio has remained largely stable, or in fact has increased. Its growth rate suffered, but at the same time our GDP was also suffering at that time. Our GDP also was growing at a much lesser rate. So that is why it maintained itself. Now we will look at the capital markets. In the capital market, let us first look at the equity. So do not worry yourself with these numbers. I will give you some idea here. Okay, so the purpose is not to scare you with this data. These are some of the tables from the survey, and what we want to see here is a bit of the growth. So let us look at it here. Okay, so this is the investment by the FPI, or investment by the foreign institutions in India. And if we see how much they purchased and how much they sold in India, then we see the numbers is largely stable, and we do not really can expect any kind of stability in FPI otherwise, but this number is largely stable here. They're investing, or they are purchasing somewhere close to 15 lakh crore rupees worth of shares from our stock markets, and they're selling roughly somewhat less than this. So in net terms, 1 to 2 lakh crore rupees of extra purchase they are doing in different years. Okay, and this reflects their net investment. Again, there is no trend here. This is what I wanted to reflect, that you can never count on your FPI. FPI is a number which is never stable. See here, 48,000, then next year 1,44,000, then minus 38,000. So this is what we wanted to see. There is no stability in the net inflow of FPI, and any country which depends upon FPI faces too many ups and downs. Okay, so this is exactly what I was reflecting to. And this is the cumulative net investments. Okay, how much they have invested into Indian economy, and in cumulative terms, their investment today is $288 billion in India. Okay, so their overall investment in India is quite significant, $288 billion. So two takeaways from this: do not remember any of these numbers, any of the number. Just remember two things: that FPI is never stable. You can never count on FPI. You can never rely upon FPI. FPI is too much fluctuating, suddenly increasing, suddenly decreasing, and it is never under your control. This is the reason why it is called hot money, and we can see it here. This number gives you the proper idea, the net of the sale and purchase. Suddenly negative, then suddenly too much increase. You can't really make any kind of expectation. And when we see their overall investments in India over the period, then you see that if you look at the long-term trends, then over time, yes, they are increasing. Their stake in India is increasing. So these are the two things we wanted to show you, that over time, the stake of foreign institutions is increasing in Indian economy, but you can never rely upon it. Now, something which is more important than the foreign investor, and that is the retail investor, common public. And this is a very good trend for India. The share of the individual investors, that was 36% 6 years ago, let us say. And there has been a steady increase, and today it has come close to 45%. So a very big jump in the participation of common people into the stock market. It is a positive sign. It is a good sign, and it is also reflective of what we have already seen in the bank's rate. Banks are giving less interest rates now. Okay, bank FD rates have gone down. So a lot of people who otherwise used to play safe, they used to deposit their money in banks, now believe the banks do not pay anything and we have to take some risk, and they're coming increasingly through mutual funds. And this is why the share of common public has increased, okay, largely because of the increasing investments in the mutual funds. And then the next thing is the share of India in the emerging market index. In the overall emerging markets, the share of Indian stock market capital was around 6.5% 10 years ago. 10 years ago, Indian stock market was around 6.5% of the emerging market overall value. And today, the value of Indian stock market has increased almost to 13%. That means the market capital of Indian economy compared to other economy has doubled. Okay, so that is something we need to understand. So our capital market is rising in size. The foreign investments are rising in size, and also the share of individual investor is rising in size with time. So a good trend here as well. And also you can see our Sensex, Nifty, etc. have increased significantly. So that also verify this phenomenon. And now let us talk about the bonds. We are talking about capital market, and within that there is equity market, there is debt market. Bond is the most important reflective of the debt market. So let us talk about it. Now here, first of all, the government bonds. How much is the government payability or interest rate on the government bond is behaving? So from 2017 to 2019, the interest rate on government bonds increased significantly. Okay, borrowing cost of government increased. But since then, we see a steady decline in the government borrowing rate. Okay, from here to here. And once again, we see the government bonds increasing. So there is nothing very specific here. You do not have to remember any kind of, there is nothing unusual. Okay. So the interest rate on government bond increased, and then when the general policy rates decreased from 2018 onwards, then we see a continuous decline in the government bond market. So only thing that we have to get from this data is that government borrowing is also subject to the policy rates. As policy rates will increase or decrease, the cost of government borrowing will also increase or decrease. And then this data, the corporate bond market. So the public issue and private placement, what does it reflect? The public issue is very, very less. You can see here. Look at the total number of public issues through corporate, for the corporate debt have been very, very low. Few thousand crore rupees only. Around $1 to $2 billion, and in between it went up to $4 billion, but not too much. Not too much. Okay, so corporate bond market, when it comes to the public issue, is very, very less. People do not issue debt to common public. But there is another development we see in Indian economy here, a very significantly high number of private placement. What is the meaning of private placement and what does it reflect? This number we wanted to understand. Traditionally, public issue was the common route. Private placement was not that much high. But now for several years, private placement is rising. And what is private placement here? Private placement is the money largely coming from the venture capital route. When you purchase equity in company and you give them money. And since we are talking about corporate bond here, basically you are giving them private debt to the companies. So now large number of companies have another source of financing, and that is the venture capital. Venture capital not only provides you equity, which is also very, very important, but they also provide you significant debt. And this is the reason why we see a startup revolution in India in last few years. आज से 20 साल पहले किसी को कंपनी स्टार्ट करनी होती थी तो उसको फाइनेंस नहीं मिलता था, ना वो शेयर बेच सकते थे, ना वो लोन ले सकते थे। लोगों को अपने आइडिया को एग्जीक्यूट करने के लिए पहले 10-10 साल 20-20 साल नौकरी करके पैसा जोड़ना पड़ता था, और फिर उसके बाद कहीं जाके थोड़े से पैसे से वो स्टार्ट करते थे, और फिर उनका आइडिया अगर थोड़ा सक्सेसफुल होता था तब जाके वो कहीं से फाइनेंस अरेंज करते थे। लाइफ निकल जाती थी एक प्रोडक्ट को लॉन्च करने में. नाउ you have an interesting idea and you make a prototype in next 2-3 years, immediately you can get funding. Okay, because startups are now attracting a lot of investments, not only in India but also from abroad. So venture capital has changed India's capital markets, and there is a lot of private placement today in both debt and equity. We have the numbers for the debt. In economic survey there was no number of equity, otherwise I would have shared that with you. Okay, the rise of unicorns in India, that is because of this sudden increase in private placement. We see big numbers here. Okay, steadily increasing roughly, and these numbers are less because these are half yearly number. Okay, the last two rows, these are half yearly number. Do not think the number has decreased. The number is continuously increasing. So this is an interesting thing. The private placement is changing the way Indian companies get finance, and a good thing for India. And now coming to our last slide, where I do not have to explain anything. I just wanted to show you a certain trend, and that is regarding digital payments. So digital payment are rising very fast, and that is a good trend for India. You can see rising from 2016 when there was demonetization. From demonetization period, UPI started, and now we see a big jump in the UPI numbers. Okay, the value of the UPI transfers have increased up to the, just a minute, is 60,000 billion rupees. Okay. In dollar terms, it is almost 900 or 850 billion dollar. That much it has increased, and it is just multiplying over time, doubling year over year. You can see in between from 20,000 to 40,000, and then from 40 to another 60. Okay, so that is how it is increasing. The digital payments are rising very rapidly, and that is a good thing for us. The good thing, because digital payments are recorded. Government can check the records. And when our transactions will get recorded, that means more and more people will come under the tax system. The economy will become formal. There will be more recording of transactions. And that would be the best thing for us to happen, because our tax to GDP ratio is already very low, and we should increase it. So digital payments, and with that, the increasing formalization of economy would be a good thing for India in coming time. Okay, and this is the number of banks in the UPI, so that is also increasing. So digital payments increasing is also another positive trend for India. And with this, I end up this session. Thank you.